Let's dive into the heart of the economy, stock markets. These dynamic arenas are where fortunes are made and lost, and where the collective hopes and fears of millions are reflected in real time. Every tick of the market tells a story, not just about companies, but about entire nations and their economic health. Think of them as bustling marketplaces where people trade tiny pieces of companies, known as stocks or shares. Here, investors from all walks of life, seasoned professionals, pension funds, and even everyday individuals come together to buy and sell ownership in businesses. The energy on the trading floor is palpable, with deals happening in seconds and fortunes shifting in the blink of an eye. Owning a stock means owning part of a company, whether it's a German car manufacturer, a French fashion house, or a cutting-edge tech startup in Amsterdam. When you invest, you're not just buying a piece of paper, you're buying a stake in the future of that business. Your fortunes rise and fall with theirs, making you a participant in the broader economic story of Europe. Stock markets are economic thermometers, measuring the temperature of investor sentiment and the health of the economy. When markets are hot, optimism is high. When they cool, caution prevails. Analysts and investors alike watch these signals closely, using them to make decisions about where to put their money next. Rising prices indicate investor confidence, while falling prices signal fear or uncertainty. These movements can be triggered by anything from a new government policy to a sudden shift in global trade. Sometimes even a rumor or a tweet can send shockwaves through the markets, causing prices to surge or plummet within minutes. Major European indexes like Germany's DAX, the UK's FTSE 100, and France's CAC 40 act as barometers for the financial world's mood. These indexes track the performance of leading companies and provide a snapshot of how investors feel about the future. When these numbers climb, it often signals growth and prosperity. When they fall, it can be a warning sign of trouble ahead. Today, November 11, 2025, optimism reigns as European markets rise, driven by global events. Investors are reacting to positive news from both sides of the Atlantic, and the mood is one of cautious excitement. This surge reflects not just local developments, but also the interconnectedness of economies worldwide. The reasons behind these market moves are often complex. They can include everything from new trade agreements and technological breakthroughs to shifts in political leadership or changes in consumer behavior. Understanding these factors helps you see the bigger picture and anticipate what might come next. Understanding these connections empowers you financially. By learning how global events influence European markets, you can make smarter investment decisions and better protect your wealth. Whether you're a seasoned investor or just starting out, knowledge is your most valuable asset. Decisions in Washington, D.C. can impact your European investments. A new law, a change in interest rates, or a diplomatic breakthrough can ripple across the Atlantic, affecting everything from stock prices to currency values. The world's economies are more connected than ever before. This script will break down recent events, from U.S. political resolutions to UK economic news. We'll explore how these developments shape market trends and what they mean for investors like you. By connecting the dots, you'll gain a clearer understanding of the forces driving today's markets. As we journey through the latest headlines and market data, remember that every piece of news is part of a larger puzzle. The more you understand about how these pieces fit together, the better prepared you'll be to navigate the ever-changing world of finance. By the end, you'll grasp why the market is optimistic and what it means for the future. You'll be equipped to interpret the signals, anticipate changes, and make informed decisions, no matter where you are on your financial journey. Why should you care about U.S. political squabbles? At first glance, a government shutdown in Washington might seem like a distant drama, something that only affects Americans. But in reality, the ripple effects of a U.S. shutdown travel far beyond its borders, reaching right into the heart of Europe and beyond. The decisions made in the halls of the U.S. Capitol can have a direct impact on your job, your investments, and even the price of goods in your local shops. Because our economies are interconnected, the global financial system is like a web with the U.S. at its center. When something shakes that web, everyone feels the tremors. Trade, investment, and even consumer confidence are all linked. If the U.S. government grinds to a halt, it can disrupt supply chains, delay international deals, and make investors nervous everywhere. The U.S. economy is a massive ship. When it slows, everyone feels it. Imagine a giant cargo vessel suddenly losing power in the middle of a busy shipping lane. Other ships have to change course, slow down, or even stop. That's what happens to the world economy when the US stumbles. Wall Street's jitters can quickly spread to stock markets in Paris, Frankfurt, and London. European companies like Volkswagen and LVMH rely on American consumers. When Americans stop spending because of uncertainty, European exports, from cars to luxury handbags, take a hit. Factories may slow production, and workers in Europe can feel the pinch, even if the shutdown is thousands of miles away. A US government shutdown creates uncertainty, which markets hate. Investors crave stability and predictability. When politicians can't agree, it sends a signal that things are out of control, and that makes everyone nervous, from small business owners to major banks. Investors pull money out, affecting both US and European markets. When confidence drops, people sell stocks and move their money to safer places. This can cause stock prices to fall not just in New York, but also in Frankfurt, Paris, and Milan. Pension funds, retirement accounts, and savings can all take a hit. The end of the longest US shutdown was a relief, signaling economic stability. When lawmakers finally reached a deal, it was like a weight lifted off the shoulders of investors and business leaders everywhere. The news was welcomed not just in Washington, but in financial centers across the globe. European investors saw this as a green light to buy stocks. Markets rebounded, optimism returned, and companies could plan for the future again. The sense of relief was almost tangible, as if a storm had finally passed. The American economic engine restarting meant renewed hope for European companies. Orders picked up, factories resumed production, and business leaders could breathe easier, knowing that the world's largest economy was back on track. This collective sigh of relief was felt from Frankfurt to London. It's a reminder that in today's world, what happens in Washington doesn't stay in Washington. The health of the US economy matters to everyone, everywhere, and a shutdown is never just America's problem, it's the world's concern. What is a government shutdown? In the US, Congress must approve funding for government operations. A shutdown occurs when Congress can't agree, halting non-essential operations. The recent shutdown, the longest in history, affected federal employees and the economy. Air travel disruptions and closed national parks hurt various industries. Ending a shutdown requires Congress to pass a funding bill, signed by the president. The resolution reduced the risk of a US recession, crucial for Europe. It allowed investors to focus on company performance, not political drama. This shift from fear to fundamentals sparked a positive rally in European markets. Emotion drives markets, fear and greed. The US shutdown fueled fear. Investors sold stocks, seeking safety in bonds and cash. Even strong European companies saw stock prices fall due to global fear. The shutdown was a constant reminder of economic fragility. The resolution was a powerful emotional shift, lifting the fog of uncertainty. Confidence returned as the US government resumed functioning. Investors saw opportunities for growth, sparking a relief rally. European stock indexes posted significant gains, fueled by renewed confidence. The end of the shutdown reignited optimism in European markets. Let's focus on the UK, where economic signals are crucial. The UK's labour market data showed a slight rise in unemployment and slowing wage growth. This cooling suggests the economy is losing steam. Slowing wage growth is linked to inflation, the enemy of purchasing power. The Bank of England watches wage growth closely to manage inflation. The data indicated previous interest rate hikes were working. Investors now expect potential interest rate cuts, boosting market optimism. The FTSE 100 rallied on this news, reflecting positive sentiment. Market health also depends on company performance. Vodafone raised its outlook after strong results, boosting the FTSE 100. Munich Re reported a huge profit, signaling stability in the financial sector. SoftBank's AI-driven profit surge electrified the tech sector globally. These successes showed that strong companies thrive despite challenges. Corporate health added another layer of optimism to the market. Oil prices are critical, affecting every part of the economy. This week, oil prices dipped slightly, despite market optimism. A potential supply glut was the main reason for the dip. Lower oil prices benefit consumers and businesses, reducing costs. This created a favorable scenario for stocks, reinforcing positive sentiment. Markets move due to interconnected forces. Political, economic, and corporate. The U.S. shutdown resolution removed a major uncertainty. UK economic data suggested potential interest rate cuts. Strong corporate earnings confirmed business health. This trifecta of good news fueled market optimism. Political resolution, economic data, and corporate profits created a perfect storm of positivity. As of November 11, 2025, a renewed sense of hope swept through the financial markets, bringing with it a cautious but noticeable optimism. After weeks of uncertainty and volatility, investors and analysts alike began to see glimmers of stability and opportunity. The mood on trading floors across Europe shifted, as early morning sunlight streamed through city skylines, symbolizing a fresh start for the week ahead. The surge in European stocks was not just a knee-jerk reaction, but a rational and measured response to a series of positive developments. Investors responded to encouraging news with renewed confidence, and the uptick in market activity reflected a collective belief that the worst of recent turmoil might be behind us. Markets, by their very nature, are forward-looking. They constantly adjust to new information, pricing in expectations for the future rather than dwelling on the past. This week, the outlook brightened as analysts pored over data and projections, searching for signs that the economic recovery was gaining traction. The bustling city traffic outside mirrored the renewed energy and anticipation within the financial sector. One of the most significant catalysts for this positive shift was the resolution of the U.S. political crisis, which had cast a shadow over global markets for weeks. With uncertainty easing, investors around the world breathed a collective sigh of relief, and global stock indexes responded with strong gains. The interconnectedness of today's markets means that political stability in one region can quickly ripple across continents, lifting sentiment everywhere. In the United Kingdom, a surprisingly strong jobs report shifted expectations for interest rates. This development boosted British stocks, as investors recalibrated their forecasts for economic growth and monetary policy. The Bank of England's response to this data will be closely watched in the coming weeks, as it could set the tone for broader European markets. Corporate earnings also played a crucial role in reinforcing market confidence. Major companies like Vodafone, Munich Re, and SoftBank reported robust profits, signaling that business fundamentals remain strong despite recent headwinds. Confident executives outlined their strategies for the future, reassuring shareholders and employees alike. Meanwhile, a slight dip in oil prices promised some relief for both businesses and consumers. Lower energy costs can help ease inflationary pressures and support economic growth, making this a welcome development for many sectors. Taken together, these elements painted a picture of a healthier, more resilient economic landscape. From bustling offices to vibrant city streets, there was a sense that the foundations for recovery were being laid, and that opportunities for growth were emerging once again. However, it's important to remain cautious. While optimism is warranted, challenges and uncertainties still lie ahead. Economic recoveries are rarely smooth, and unexpected events can quickly change the outlook. Investors must stay vigilant and avoid complacency. Enjoy this renewed sense of optimism, but remember to stay informed and disciplined in your financial decisions. Whether you're managing a household budget or making investment choices, knowledge and preparation are your best allies. Use the insights from this week as a foundation for your own financial journey. By staying aware of market trends and understanding the factors that drive change, you can become a more successful steward of your financial life, ready to navigate both the opportunities and the challenges that lie ahead.